CBA's positive outlook for the Australian economy in 2021. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at CBA economists' predictions for the economy in 2021. They have a positive outlook. So, well, let's see. Now, they made some of the harshest predictions, particularly for property price falls. Now, the more and more I think about that, I suspect some of those announcements from the RBA of potentially modeling 40% falls and from the banks, 20%, 30% falls in some cases, might have been done for political purposes to prompt the government to push more money into stimulus and support. Maybe that's just a little bit conspiratorial. My tin aluminium foil hat that I'm putting on. Who kidding? We can't afford tin. It's too expensive. What do you reckon? So let's have a look, because it seems the government is chucking everything at housing. It's doing everything it can to prop up aspects of the economy. The economic and market outlook for Australia in 2021 is looking more positive, according to Commonwealth Bank's chief economist, Stephen Holmerick. Mr. Holmerick said, while the spread of the pandemic had undoubtedly had a significant impact on the Australian economy, financial markets and monetary and fiscal policy, the implications have pleasingly been less severe than originally predicted. Well, it's the lockdowns that they implemented to mitigate the spread, not the spread itself. You need to be quite clear about that. And remember, there's a price that we're paying to mitigate this illness, and that's an economic price. We just need to keep that in mind, particularly where in the future, if people call for the same type of interventions. I'd love to see some economic modelling before government makes these decisions. Australia has done a better job than just about any other nation in controlling the spread of the virus, he said. This, combined with fiscal and monetary policy support being provided to the economy and the role played by the Australian banking system, means the economic impact of COVID-19 has been less severe in Australia than many other nations and less severe than initially expected. Well, here's the thing. Our cash rate has crashed at 0.1%. Remember when 3% was considered an emergency rate. So that's an unnaturally low rate. This is a sign of an intervention in the market. You also have mortgage holidays that have been extended out until this year, and the banks publicly, CBA in particular, saying they won't repossess anyone's home or do a forced sale until September. You also have other interventions like the insolvency cliff that we're facing in a few days as well. This is the personal insolvencies. Look how far below it is below trend, everyone. And you also have businesses trading while insolvent. This shows you the percentage of insolvencies we have now compared to the same time in 2019. We're running at less than half. That's either a sign that fantastic, the economy is doing really well, no one's going insolvent, or that everything is being propped up by the government and the laws put in place to mitigate insolvency are having an effect. We also have a job seeker boost. You can see here that the number of people that have gone on government welfare or support has significantly increased from earlier in the year. I mean, look at that, the job seeker boost. If we scroll down here, you can see the hundreds of thousands of people that are on this program. Then we have as well JobKeeper supporting businesses. And when you look at the workforce, the employed people on JobKeeper, Victoria is 8.76% of the employed people on JobKeeper. New South Wales 7.95%, Queensland 6.84%. And then I did something a bit cheeky and added that to the public servants. You can see how many people are supported by the government. And let's not even add you wouldn't, if you add welfare to that, that'll be even more. But this is how many people, employed people, are supported by the government either via JobKeeper or public service roles. Like a fifth to a third of the economic activity in those states. So this is all the fiscal, monetary and government stimulus that they're talking about here. We also have, don't forget, the moratoriums on rental evictions. How's that going to affect the property sector? So, to be sure, Australia's 30-year run without a recession has come to an end, and the human toll of the sharp rise in unemployment rate has been very real, but the outlook for Australia is improving. He said one key consequence of the current health pandemic had been on the impact on monetary policy. The recession, the rise in the unemployment rate, the global economic environment, and the expectation that inflation will remain below the 2% to 3% target range for years has seen monetary policy in Australia enter unconventional space for the very first time, he said. Well, we're doing QE. The RBA is quantitatively easing, and I mean, the question is, 0.1% is insanely low. If you're with inflation at 0.7% and some of the interest rates you can actually earn from your savings, on certain bank accounts, you're going backwards. Your purchasing power is actually decreasing from the CBA, their advanced saver account. The cash rate target is expected to remain at just 0.1% for at least 3 years. The RBA is funding the banking system for 3 years at 0.1%, and the RBA is targeting the 3-year Commonwealth bond yield at 0.1%. In addition, the RBA is now engaged in a quantitative easing program and will buy $100 billion of Commonwealth and state government bonds over the next 6 months to April 2021. This strategy provides the nexus between monetary policy and fiscal policy in Australia. The RBA governor insists that the RBA is not financing the government directly, but the $100 billion QE program will go a long way to supporting the Commonwealth and state governments' borrowing programs for 2021 and likely beyond. Having entered the world of unconventional monetary policy, it is going to be a long time before the RBA can retreat from providing significant support for the economy. Well, here's the question I'd put to our economist here. Are they even going to be able to get out of it? Are they ever going to be able to normalize rates and stop this? What's going to happen to the market? If we're doing all of this intervention now just when we hit a recession, what's going to happen when the market gets addicted to this, to all this stimulus? We already see cuts to job seeker, which are happening in a couple of days, is becoming a political potato. It'll be interesting to see when the election is called and how that will have the biggest impact if it happens next year. Looking ahead, Mr. Helmerich said 2020 would likely be the weakest year for the global economy since World War II, but 2021 is expected to be a better year. We do expect a solid recovery in 2021 and a global growth forecast at 5.2%, led by US and China, he said. In the US, there remains a number of political risks ahead, but assuming Joe Biden is sworn in as the 46th president of the US on the 20th of January 2021, we expect him to focus on a few key policy priorities that should support the US economy throughout 2021 and beyond. Heading into 2021, Mr. Helmerich said the key areas to watch would be the diplomatic relationship between Australia and China and its impact on our trade, as well as the effects of climate change and climate change policy on the Australian economy and financial markets. So there we have it, everyone, a positive outlook for the 2021 economy from CBA. But considering how much of it is being propped up by government changes to the rules, by government intervention and fiscal policy, do you agree with a positive outlook for 2021? And I mean, we've got QE now, and the Reserve Bank has said pretty much we'll do it as, they're saying $100 billion a year QE program, but they're going to keep going as long as they have to. And remember, every bit of money that the RBA magics out of nowhere or transfers into circulation will have a catalan effect, everyone. And to remind those of you that aren't familiar with this, the catalan effect refers to the change in relative prices resulting from a change in money supply. The change in relative prices occurs because the change in money supply has a specific injection point and therefore a specific flow path through the economy. Sure, for the banks going from the RBA, it's all going through a specific path. The biggest example of a bubble created by the catalan effect here in Australia, I would argue, is property. Most certainly property prices, because we can see, property's just gone up a little bit over the last decade, just a tad. Where do you think most of the money is created in our economy? It's when people borrow it. And where does it all go? Where does everyone park their money in Australia? In property, in housing. That's where we're seeing that effect manifest. We'll have to see, everyone. What are your predictions for 2021? Do you think it'll be a good year? Do you think it will be fantastic? How are you preparing to take advantage of it? Do you think property will remain in a bubble as it has been? What else can the government do or throw at it to keep it going? Let me know your thoughts and opinions in the comments down below. If you're a fan and want to support the content I create here, there are a few ways you can. you can join us on YouTube or Patreon. Support us using our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I will see you all next time. Bye for now.